thank you everyone for being here today. It's wonderful to see some familiar faces in the audience. And I'm Lily Buffett. I'll be moderating the session with Sanjeev Krishnan and Delia Cristea. And I wanted to just frame, we're discussing chasing alpha in an age of volatility. So we're here to talk about alpha in periods defined by volatility, geopolitical volatility, fragmentation, capital pricing, climate risk, reshoring, and digital acceleration. The goal of today is to move beyond headlines and focus on how disciplined investors are actually navigating this environment. And so I wanted to open up the panel with a few questions. So if we step back, what is the fundamental change in the last 5 years, and how were your firms built to navigate exactly this kind of environment?
So I helped co-found a business called S2G Investments with Lucas Walton, one of the heirs to the Walmart. And we've been at this since 2013, 2014, but sort of around COVID, our thesis really evolved to, our view is, we're going from sort of the era of moderation to the era of volatility, and really anchored the firm of the last 30 years are not going to be the next 30 years. So it's sort of a hybrid investment organization. How do we, use that to our advantage? And we're building the firm around sort of 5 transitions that I think the world is going through at once. Sort of CPU to GPU, shorthand for AI, unipolarity to multipolarity, so geopolitics are evolving, a declining price of money to an unknown price of money, really around monetary uncertainty, 1.5 degrees to 2.2 degrees, and then aging from a demographic dividend to a demographic tailwind. Each of these 5 have enormous investment implications and opportunities. I think our view, the cocktail of all 5 of those are really going to change beta over the next 5 to 25 years. And then if you look at the last sort of 300 years of beta and alpha periods, it's marked by similar levels of, railroads led to a new beta on capital markets, really scaling. The bond market grew 6x. There were lots of, alpha and the beta changed. Electricity was one of them. And then the third was, after World War II, Bretton Woods. The last one was, in our view, and particularly my view, that it was Richard Nixon. I think was the author of the last 30 years. He took us off the gold standard. Debt went from $3 trillion to $300 trillion. Opened up China, the lid to modern globalization, which is now, he didn't architect this, but Moore's Law effectively was during this period. And obviously, global demographics led to the growth of middle class globally. And so, to me, we're living through the next sort of beta change. You're seeing this in software stocks today, or the last few weeks. And I think as we get into the panel, there is so much different stuff where the beta is changing, and there's sort of opportunities for alpha in terms of asset class sectors that we can talk about.
Mm-hmm. Great. So I'm Delia Cristea. I'm the CEO of Power Sustainable. We're an alternative asset management firm, head office in Montreal, investment teams across North America. We're later stage investors, so infrastructure and private equity. And we work with the same structural shifts that that Sanjeev was talking about. Actually, they're not new. They've seen the headlines, so did we. Power Sustainable was started about 5-6 years ago with those structural changes in mind. What's different more recently is not the changes, not the climate was there, so was the digitalization, so was the geopolitical shifts, multipolar world. We started talking about China is rising, the rise of China, the rise of the global south. What we see, though, is that balance sheets are starting to recognize those shifts, and that's happening faster and faster. There's an accelerated change, and what's becoming also interesting is increased complexity in how these forces interact with each other. And it all sounds very abstract right now. We'll talk about it later, what it means in practice. So how does Power Sustainable respond to that? We said, well, the future economy will be built in those core sectors by the companies that actually understand those structural shifts, are either resilient to them or create opportunities around those sets. So talk about digital infrastructure. We knew there will be more and more built, but we invested a lot in it on the infrastructure side through our private credit strategy, but also with resilience in mind. So digital hyperscalers in Canada, we invested in one of them on a decarbonized grid. Actually, that's paying into now the reshoring shift and the focus of the Canadian government around bringing some of that digital capacity back home in Canada. So these things are starting to interact. Where we're focused is core sectors of the real economy. Why? Because the demand will be there no matter what happens. So those are energy, digital, industrials, food security being very important, and built environment. And across those, we invest in both infrastructure through our two infrastructure strategies as well as private equity. And we'll talk more about the how soon. Over to you, Lily.
Yes, let's ground the conversation in a few examples of what you're investing in and how this fits this sustainability conversation and the shifts and evolution of it over the last 5 years.
Yeah, so maybe I can give two examples of platforms we backed. One's called Track. Some folks may be investors. We Track is a data center company started by Grant Van Ruin, who started two others. This is his third one. And he effectively bought or optioned with our capital and other capital about 30,000 acres of data center acreage pre or around ChatGPT's launch. So effectively underwrote that acreage to public cloud and then a call option for training and inference. So if you think about data centers that were supposed to go from 80,000 acres to 240,000 acres, the biggest growth is inference. And to us, that's a bit TBD, whether AI is actually going to lead to productivity. There's a revenue model that you can defend it. But it's an example of sort of an alpha move that he was able to do with ours and other capital, where he bought it at prices that today, that trade is pretty increasingly quite crowded and there's a lot of noise and signal. So I think that's one sort of tangible thing that's done really well. We also started our farmland fund where we buy commodity farmland, convert it to organic regen with the view of getting a higher cash yield. And so typically that asset class is a 1-year cash rent, and we do a 7-year rev share and have been able to achieve sort of 2x the cash yield of others. Where we like that is we think, one of the conversations that I think as modern portfolio gets tested, asset correlations get tested, the role of diversifiers in a portfolio and real assets are going to be more interesting. And it's agriculture, it's energy, it's all these sectors that I think offer diversifiers as increasingly there's more volatility. And I think it has obviously gold and silver and Bitcoin have taken that mantle, but we think there are real asset opportunities in energy and agriculture that could offer diversifiers to portfolios.
Mm-hmm. So I'll jump in. I love the question about sustainability. I'm going to be cheeky and venture to guess that if this panel was called anything sustainable, people, like half of the room would be empty. It's an unpopular word this day, but it's also a word because it was wildly misunderstood and I think still is. So sustainable used to mean ESG layering and used to mean compliance, a lot of due diligence and all of that. It also meant concessionary capital to some. And let's be clear, nothing that we invest in right now, including in renewables, including in food systems, including in anything, would have been what it is. None of those solutions would be there without concessionary capital. So it does have a role to play to catalyze all these solutions. We're in later stage. So if you want, we're vanilla infrastructure and vanilla private equity. We focus on any allocation like that. But for us, sustainability actually is a very pragmatic approach. If you have a fiduciary duty, then both from a risk and opportunity perspective, you look at resilience of your supply chains, resilience of your energy footprint and everything else. So maybe 2 examples. I'll go to ag as well. It's a space that we share, and we actually are investors in different parts of the food and ag system. A while back, we looked at investing in vertical farming in Canada because, well, Canada gets most of its greens and winter from US. And from a climate resilience point of view, we knew that these needed to be addressed and would be a great investable opportunity. That was 4 years ago. 3 years ago, we invested in this company that's called GreenLeaf. We took it from 2 vertical farms to full scale across Canada, and it's continuing to build. We knew that supply chain reshoring will be an issue from a resilience point of view. We also knew about the multipolar world, and we couldn't call. I wouldn't say that we had a, we had a crystal ball to actually foresee the past year, but from that point of view, it played in our favor. So tariffs happened all of a sudden. All of the great players in the Canadian food market were sourcing greenery from these vertical farms. Why? Because, well, it wasn't just cost. It was the volatility of dealing with the cross-border issues that made them source there. And we think that trend will continue. So I was talking earlier about now these macro trends playing against each other, with each other, reinforcing each other. This is one of them. The reshoring of supply chains because of geopolitics and security is actually might accelerate some of the changes that are made for climate resilience. Energy security being one, but the other one, the one that has to do with securing food systems. So we'll talk more about other examples, but go ahead, Sanjeev.
I think one thing that is to note is I think climate's become oddly a dirty word that like people use every other thing. It is our view that it's the longest economic megatrend in human history. So the equation we use is you take useful energy and you turn to useful materials. And so we started with obviously fire, then photosynthesis, and then fossil fuels, and sort of whatever comes next. And if you think about the useful materials, it was calories, electrons, energy density, molecules, water, the thing that we use every day, multiple times a day. And what's happening now, though, if you believe that AI will lead to economic productivity, that useful energy to useful materials suddenly, potentially intelligence, reasoning, workflow automation on the service sector. I was on a conversation last night with a common friend of ours, and he's on the board of he's very well regarded in energy. The conversation we're not having fully is the gross margin structure of AI. It's going to be fundamentally, a physics issue as much as anything else. And so while we're still focused on sort of the revenue model of all these things, the gross margin visibility is very unclear. And I think it provides that load growth is going to grow. And the relationship between electrons and the gross margins of AI, I think, are going to be much more collided in a way that was never done before. And it's, this climate equation, useful energy to useful materials.
So as you're looking at in this environment, where are returns actually being created? And how do you create value as we're looking at this transition, as energy transition and AI?
The $1 trillion question, the many $1 trillion question. So here's the power sustainable, not bet, but maybe strategy, actually, importantly. We will continue to do what we were doing 5 years ago. It's working great. Focusing on on these core sectors that we believe are now becoming critical to some of the shifts. So again, food, digital, energy. They're becoming key to the conversation everywhere about national security. When they talk about national security in Canada or independence, they don't talk only about defense. They're talking about food systems. They're talking about electricity. They're talking about digital. They're talking about all our infrastructure. Same thing across the world. Yes, everybody talked for at least a couple of days about the PM speech in Davos. We all loved it on the Canadian side, where the investment community is aligning with it, and whether you're in Canada or elsewhere, is that the expectation that we will go back to the world before these macro trends is not the right one. So we will continue to invest in those areas across the supply chains. I'll be more specific than that. So there is in Canada, we'll talk about Canada and maybe a bit about the US afterwards. In Canada, there's a complete retooling of the economy driven by the government that's acting both as catalyzer of foreign direct investment, but also catalyzer on the policy shift. Industrial policy is back on the table. It's back everywhere in the US as well. So some of the sectors are privileged from that point of view. The sectors that are the government is focused on, and so are we because we can play with our asset classes, are first of all infrastructure around energy, defense, and by defense we don't mean we're not going to do direct investment in defense, but there's a lot of infrastructure built out around it, from housing to everything else, roads that will go to the Great North and everything else. Critical minerals. Canada has a lot of resources there. We export, I mean, we haven't dug up half of them, not even 10%, but most of them get exported to China and Taiwan. We talk about digital and renewables. The critical piece of it is minerals. So a lot of projects are going to be developed in the next couple of years, and what we see also is a policy shift. So a lot of the permitting is accelerated on all of those. Also, as I said, the government is acting to catalyze capital, so there's foreign investment flowing in towards the end of the year, and we're at those tables with all of the 4 strategies because there's space for credit and infra equity and for a private equity that actually invests in the enablers, in the service providers across those supply chains. That's the opportunity set, and that's where we want to focus. Same thing in US and in Europe, really. Across those core industries, there's similar plays by different governments and with different actors at the table, but that's the focus for us for the next couple of years at least. The future economy, we call it, but that's very abstract to everyone. That's kind of what we think it looks like.
And if you look back in 10 years, what will define the investors who've navigated this period successfully?
Sanjeev is the visionary, so you should answer first.
I mean, I think it depends on what asset class that you're in, because I do think some require larger duration, some are IRR sensitive, some are more MOIC driven. I think that I saw this quote yesterday, like the new economy has never been more linked to the old economy for the success of the new economy. So I think behind the meter power is going to be critical to get, everyone's ordering NVIDIA chips, but to plug it in, it's natural gas, maybe some curtailed power with battery, solar, et cetera. I mean, those industries have never historically had to talk to each other. If you really believe in physical AI, autonomy, battery, robotics, humanoid robotics, the critical minerals need, and so this is mining, has never been more dramatic in terms of people talk about copper, but the scandium, a lot of the rare earths that go into these supply chains for humanoids and others. So I think there is going to be a convergence of people that really understand the old economy, because a lot of the supply chains to feed this new economy are rooted in things that are very hard, very asset intensive, very low margin compared to SaaS, although SaaS terminal values are under challenge now. So I think it's navigating the old economy to feed the new economy and kind of being expert at both, because ultimately the ability to hook up a chip, if chips are going to be substitutes for labor, it's going to require electrons. If robotics and physical AI are going to take over labor, it's going to be mining intensive. So I think folks that can navigate both worlds, I think will do well. I also think, I'm of the view that modern portfolio theory is going to change. And I know everyone looks at total portfolio, but the correlations are going to break down. And I'm really excited about the role of diversifiers and how creative can you get in terms of building some of those platforms that can truly offer an alternative to gold, silver, and Bitcoin.
It's hard to follow that. Maybe just a couple of things. We obviously believe that the winners in 10 years are those who focus on those core sectors. Why? Because they're required for economic stability and social stability. We believe that those who win are those who don't chase fads, are long-term investors and are wise about it. And lastly, we all need to remember that investment is not political. However, we need to all understand policy because it is affecting the day-to-day lives of our portfolio companies and our infrastructure. But whether climate exists or not, and whether resilience needs to happen, is not a political issue. It's a real asset issue. So that's how we invest and will continue to do so. If it's unpopular from time to time, it doesn't matter. We know that the long term will tell. And we have a lot of institutional investors as well as family offices who have that long-term view, and we're happy to have them as partners. So we'll see.
So Sanjeev, you were saying that modern portfolio theory is going to change. Do you see a greater percentage being invested in alts, or what is your view?
I think, like if if it came out of University of Chicago in the 50s, really scaled. When we've had stable inflation, predictable growth, sort of attractive demographics that led to consumer-driven society, and the Sharpe ratios were strong, the asset correlation were predictable, and then hence ETFs are born to get low-cost diversification. I think that world is going to change, but I was talking to someone that deals a lot with allocators. The plumbing system and the incentive structures makes it, you have to really experience the drawdown or the volatility in NAV to really say, maybe that regime is gone. We set that regime aside and are building our firm around. Eventually, the beta will change, but we need to be ahead of when that beta changes. I know there's a lot of conversation at the institutional asset level of modern portfolio theory changing. People looking at total portfolio, people looking at other ways to allocate capital. But there's going to be a lag effect, and that's where I think money can be made and impact can be made because you can be ahead of it. But I do think that if you study the last 300 years of beta and alpha, which is a weird thing to study, you can actually see that, and if anyone wants, I have a whole deck on that I can send around.
That's wonderful. And well, just to have our closing remarks, I wanted to thank the panelists. Thank you so much, Sanjeev and Delia, for being here. And if there's a theme across today's discussion, it's volatility doesn't eliminate opportunity, and that the reward and discipline and durability are focuses that are essential in this period. So thank you so much for offering your thoughts on how you're addressing volatility today.
Thank you for inviting me, and thank you, I can actually.